I want to welcome everybody to the Economic Policy Working Group. We have an exciting panel today on stablecoins, and I want to give a hat tip to Mike Boskin, who suggested to John and me that this would be a good idea, and we think it's a great idea. So our four panelists are in order of how they'll be speaking is Michael Bordo, Darrell Duffie, Amit Seru, and Andy Hall. And I just wanted to tell you the ground rules. Each one will start with a 10-minute presentation. After that, we'll have a discussion within the panel, and then we'll open it up for general questions. So it would be particularly good if there weren't any questions during that first 40 minutes, a little bit less so on the more open discussion, and then we'll have the general discussion. All right, so our leadoff hitter is Michael Bordo.
Okay. Well, it's great to be back here on this panel. About 6 or 7 years ago, I gave a paper here with Andy Levin on the case for central bank digital currency. And I remember I got a lot of flack from a lot of people. Some are still here. So now we're on to stable coins. I still like CBDC, and I'll tell you why. So the Genius Act of July 2025 sets out a framework as a U.S. Congress Act, sets out a framework to regulate and promote stable coins as a digital money that incorporates the advantages of new digital technologies such as the blockchain. The Genius Act opens a number of issues on the implementation of a safe private currency, issues that were talked about, dealt with over 100 years ago. The Act ignores some potential flaws that should be revisited before it leads to a satisfactory outcome. So what I'm going to do is discuss how successful private currency was implemented in the US and Canada long before the establishment of central banks. And my focus here is primarily on stable coins as a possible form of domestic retail currency, and less on the wholesale side, and less on the international possibilities, which I think actually are very promising. So digital currency must satisfy the basic functions of money as a unit of account, medium of exchange, and a store of value. They're a financial innovation. And 250 years ago, Adam Smith wrote about this famous quote here, where he compares the innovation of banknotes over what was being used then, which was specie coin. And the analogy he made was that, using banknotes and banking would be like putting a highway in the sky, and it would and lead to this incredible social savings. So this is a very old story about financial innovation. So let me just tell you a little bit about the Genius Act, and I probably am going to leave a lot out, but the key feature of it is that it allows banks like JP Morgan, qualifying state chartered entities, non-bank financial institutions, crypto companies like Tether and Circle, US branches of foreign banks, to issue digital stable coins defined as currencies backed 100% by short-term treasury securities, cash, uninsured bank deposit, reserves at the Federal Reserve, and money market funds and repos based on government securities. There might be more to it. Okay. So the Act distinguishes between two types of issuers: large issuers with more than $10 billion in notes, and small issuers with less than $10 billion. The large issuers would be regulated by the Office of the Comptroller of the Currency, the Federal Reserve, the FDIC, the smaller ones by state authorities. And key features of the Act are stable coins would be fully redeemable on demand into regular cash money. They wouldn't be legal tender. That term isn't used in there, but that's how I interpret it. They would not bear interest, and this is a big issue, and the issuers would not be bailed out by US monetary authorities should they become insolvent. Okay, so the introduction of stable coins today has a lot of resonance to some early stories about the introduction of private currency. And the problem back in the 19th century was with free banking, national banking, and I'm gonna, if I have time, talk about Canada, was to create a no questions asked currency. And Gordon and Zhang in this paper explains this clearly. Question is, when you have a note, face value, it's supposed to be a $10 stable coin. Will it actually, when you spend it, will it be worth what it says? Okay, and this was not the case in the free banking period in the US. In the national banking period, they figured out how to do it, but it took some work. And in Canada, same story. So in a sense, I see the Genius Act as having elements of all of these three historical regimes. And I know if you looked at other countries, I mean, I know Sweden, Switzerland, a whole lot of countries, the same story is going to hold up if you look at monetary history. Okay, so what I'm going to do is I'm just going to go through these history stories, and which some of you have heard before. I mean, this is the stuff I used to do for a living when I taught this, of the courses I've taught in my life. So free banking. So if you know U.S. history, you know that after the U.S. became a country, they set up under Alexander Hamilton, they set up a central bank called the First Bank of the United States. Okay, it was shot down after 20 years by populist pressure. Okay, then they had another central bank called the Second Bank of the United States, and it was shot down too. Both of them were set up to create a uniform national currency. So that was followed then by a period of free banking. That is a period when the states regulated banks and the federal government was not in the game. And the key point is that free banking did not satisfy NQA. Okay, the regulations under free banking it was not free, but it was very easy to set up a bank. You had very low capital. Okay, they issued bank notes. The bank notes were backed by the security of state bonds, and there was an issue whether the bonds were at par or market value. They had to be redeemable on demand, okay, instantly, and they were regulated by state bank examiners. So what happened, with a lot of details I won't go into, is that all these banknotes circulated. There were large numbers of them across the country. The US was a unit banking state, so every state had a large number of unit banks. They issued these notes. They circulated at different discounts, reflecting the distance to get redemption, the quality of the backing, and they had something called a counterfeit detector, which was a magazine that a merchant would have to be able to tell which notes, what the discount was, and which notes were counterfeit. So they had ways of getting around the information problem. But despite that, it was very costly to make transactions. So to summarize that episode, you had widespread counterfeiting, frequent bank failures, panics, financial instability. Okay, now there's a whole debate about this. Okay, one thing that matters, it depended on the regulations in the states. So some states did pretty well, like Massachusetts, New York. Okay, but there were other states in the Midwest, like Michigan, Minnesota, okay, where the discounts on these notes were over 50%. These were the states where you had wildcat banking and fraud. So, without going into any more details, the Genius Act, by allowing similar issues to be state regulated, I think that opens up the same problems as under free banking. Well, now we get to the national banking period. It was set up to remedy the failures of the free banking era, and the national banks were chartered by the US government. They were unit banks. They could issue notes, and these notes were more than 100% backed by US Treasury bonds. So they got around this problem of the backing. They were supposed to be redeemable on demand in lawful currency. They had double liability, and they were regulated by a new agency called the OCC, the Office of the Controller of the Currency of the Treasury. But it still took 10 years to become NQA. Government intervention, that's the Treasury, had to basically get involved to overcome the problems. So just to list what first, it was very hard to make these notes accepted everywhere at par. Okay, the problem was they weren't at first. In New York City, they would be received, but if you had a note from another part of the country, there'd be a discount. So what they did, they set up these redemption centers. Okay, the Treasury also insured national bank notes against insolvency. It set up a gross clearing mechanism. Okay, and in a sense, it all worked very, very well. Okay, so the key lesson from that period is it took government establishment of enforceable rules to solve the problems of acceptance at par, rapid redeemability, insurance against default. The Genius Act does not detail how exactly these problems would be solved. It was solved by government intervention. What's going to happen when significant defaults occur because of similar issues? Okay, I don't have much time. Okay, I'm Canadian, so I'm throwing the Canadian story in. They had private banks. They had a private currency system. Okay, they had the charter banks. They had no central bank. They issued notes. They had backing very similar to what the national banking system is, and they evolved NQA. But again, it took the government getting involved to come up and solve these problems of redeemability, et cetera. So it took a while, but it did work. Okay, so what is the lessons that come from this? Okay, I have 3 policy lessons. Okay, a safe uniform currency is possible with enforceable rules for good behavior. But problems leading to systemic risks will inevitably require Federal Reserve, Treasury, and other regulatory intervention. So shocks to the value of backing of stable coins coming from global factors, US policy mistakes, okay, all of these things which did happen in the past, okay, that's going to affect these coins, okay? In all 3 eras, banks failed because of fraud and malfeasance, as well as shocks to the real economy, leading to contagion and panics, okay? The third lesson, and this is the end, okay, third lesson, shocks coming from other parts of the global financial system could spill over into the stablecoin space and vice versa. The Genius Act as it stands has no provision for dealing with them. A key lesson from the global history of private banking currency system is that at some point they failed to maintain the NQA principle, and they even broke down in the face of systemic. This led to the creation of central banks. It's held right across the world. It would not surprise me that yet to be revealed flaws in the Genius Act combined with totally unknown shocks could lead to introduction of a central bank digital currency, even in the US.
All right, our next speaker is Darrell Duffie.
Thanks, Valerie. Thanks to you and John for setting this up. So where Mike was drawing lessons from the past, I'm gonna look to the future. Where will stablecoins have a big impact? Is it really a big deal? And I'm gonna start with a chart that I prepared with some data that Citibank came out with last week, showing how stablecoins are used in practice up till today, and then their forecasts for 5 years from now. They have 3 different forecasts, as you can see, the A, B, and C forecast. So the blue color at the bottom shows you that, by and large, stablecoins are used today for cryptocurrency trading. So if you want to speculate in cryptocurrencies or invest in them for some other reason, good luck. But the way you're going to do it is buy and sell using a cash medium, which is stablecoins. And there are 2 dominant stablecoins today, Tether and USDC. There's a smattering of others. They're all in the single-digit billions, but Tether and USDC together are around 250 billion, as you can see on this chart. In the future, as you can see, Citi has pretty strong projections for growth in the cryptocurrency-based demand for stablecoins. This is outstanding amounts of stablecoins that are going to be used for crypto trading. I don't know what to make of those numbers because I don't actually know what to make of the numbers today. I don't know why people are trading cryptocurrencies. That's another conversation.
Right.
They have an infinite price earnings ratio. They do have some fringe uses, so do tulips. But anyway, stablecoins themselves are a different beast. They can be used to make payments. And the other two colors, the red and the green, are related to actual uses of stablecoins for doing things that we like to do with money in the quote unquote real economy. The red are the city numbers for where stablecoins they project will be used as a substitute for US deposits. Now, it's not a zero-sum game, as some of the Bank Policy Institute have suggested. It's not true that every dollar that's used to create a stablecoin is a dollar less of bank deposits, but those are big numbers in red. In a moment, I want to dive into how to break down those numbers and are they realistic? I mean, they're huge. I mean, going from nothing to potentially $1 trillion or more dollars, that's a lot of growth in 5 years. Is that actually feasible? And then I'm going to do the same thing with the green. So starting with the red, I'd like to break it into two buckets. This is US now, domestic uses of stable coins. One is the one that you've probably all been reading about, which is we're all going to someday have an opportunity to use stable coins to make our mortgage payments, buy coffee, buy a ticket to a baseball game, go to the grocery store, order from Amazon, and all of that. I actually doubt it. I don't think real retail uses of stable coins are likely to be a big deal because the network effects of established payment means in the domestic retail US economy are going to be very entrenched. They're going to be very difficult to dislodge. And the more that stablecoins improve on the payment experience, the more that banks are going to improve on their payment experience. And it is hard to get interest on a stablecoin. You don't get a United Airline miles on your stablecoins. So people, when they hit one app or the other, they're probably going to hit the app that says pay with my Visa card. The other main part of the red block, however, is, I think, potentially very important, and that's the use of stablecoins for conducting settlement of financial transactions in the back end, the core financial markets for foreign exchange, treasury securities, repo, and the like. I'm going to come to that in a minute. Just a bit on the green, international. It's now official US federal policy that stablecoins will be used as a vehicle for dollar dominance. And that is a realistic impact on foreign countries, those with weaker banking systems or very volatile inflation. You should not be surprised to see stablecoins being used. I've had anecdotal information from places like Somalia, Nigeria, Argentina, and there's also some IMF work that shows that people are actually picking up on this. JP Morgan's estimated use of that today is around $10 billion. They're also used in the international context for payments to and from emerging market economies because correspondent banking is slow and expensive. I'm not going to talk about that further because we don't have enough time, but I think that those numbers are potentially realistic, those green numbers, but they go from very small to very big, but I think somewhere in that range is not ridiculous. I want to talk more about this wholesale finance application because this is the one where I actually think this is a better technology. It's a killer app for doing financial settlement. And eventually the better technology is going to win, or at least take a large part of the current share of trading, which is in the trillions of dollars a day. So the fact that there might be multiple trillions of dollars of stablecoins for doing back-end financial settlement is not a silly idea. Here's the idea. A US bank wants to buy euros from a European bank. The US bank needs to pay $500 billion to get, or $500 million to get 400 million euros. If the US bank sends its money over and the EU bank doesn't send the euros back, the US bank lost a lot of money. I discussed this at Hoover in the context of the Herstatt events of the 1970s. That problem of settlement risk was addressed with a very expensive, cumbersome intermediary, trusted third party in the middle. It could be done very simply by a cryptographic scheme called a smart contract in combination with the use of currency stored on a blockchain, by which we mean stablecoins. Here's roughly how it works. The blockchain or other ledger keeps track of the state of everything, call that state XT. The US bank signs cryptographically an irrevocable message saying, I will send 500 million if the EU bank similarly cryptographically signs a message saying, I will send 400 million euros. Once the blockchain or ledger has both of those messages in hand, it enacts the swap, and bingo, no settlement risk, programmable, extremely convenient, fast, simple, cheap. Good idea. Last slide. The US Treasury market is already executed on Canton a stablecoin-based settlement of a Treasury repo trade. In fact, Don Wilson he's sitting over here, established the company that established Canton, which is the ledger on which this transaction occurred in August. So the idea of this is that the seller on the repo, or you can think of it as a Treasury securities sale, sends a message to the depository trust corporation saying, those tokenized treasuries that you have in my account on your ledger, put those in the name of the investor buyer, provided the investor buyer similarly sends a message to the Canton network saying, those USDC stablecoins that you have in my account on your ledger on Canton, please put those in the account of the seller. And once both of those messages are registered on Canton, bingo, you get what's called atomic settlement. These two types of applications are two examples of how the whole back end of the financial system can run much more efficiently in principle on stablecoin cash with smart settlement. So what are the caveats? Number one, well, there's a lot of plumbing out there, and unplugging it and replugging it in is going to take a long time. So this is a maybe 5 to 10 year thing. It's not necessarily going to work. Maybe something even better will come along. But it seems like the better technology, so it has a very good chance of being a multi-trillion-dollar a day use of stablecoins. The other caveat is I wouldn't do it with USDC past a few $100 billion because, as Mike said, the Genius Act only requires it to be backed by things that include uninsured commercial bank deposits. This is totally contrary to international principles called IOSCO principles for settlement or major infrastructure for settlement of things like treasury repos. It should be backed by 100% government, let's call it reserves, or it should be reserves. There's no reason that the central bank couldn't issue reserves in a tokenized form that could be used for this purpose. And so I think from a policy perspective, that would be a better choice. And that next best choice would be a more resilient form of stablecoin. It could be on a tougher ledger. Right now, USDC is on an Ethereum ledger, which is, I would call it solid, but I wouldn't call it as resilient as you would want for a $1 trillion a day market. And you have this issue that although they mostly have treasury bills, it's not all treasury bills. Why would you take that risk with a market like this? So finishing that, I think there is a realistic future in which stablecoins become a major part of our financial system, not domestically, but in the financial markets, and also as a vehicle for dollar dominance. So beware if you are running a foreign monetary system.
All right, thank you very much, Darrell. Our next speaker is Amit Seru.
Thank you, Valerie. Thank you, John. And thank you, Michael, for suggesting that this panel will be a great one. You had rational expectations. All right, so I want to say a few things which we didn't coordinate, but somehow we've ended up with kind of agreement on a few things, but coming from very different perspectives. Just so you all understand, we are trying to modernize payments here. We are trying to make dollars more available outside, maybe potentially through the Genius and Clarity Act that affects stablecoins that we are discussing. What I'm going to sort of argue here is that just because we use a lot of buzzwords and tech doesn't make the risks disappear. If you really want to understand these things, you have to get into plumbing. You have to understand how do you build trust and how do you maintain trust. And one of the things that's going to be important, like Michael said, is singleness of currency. So that's something that we got to understand a little bit. Unfortunately, no one likes plumbing, neither do I, but you got to understand this because that feeds into design and economics, which all of us like to talk about. So what I will do is I will give you the pro case for why we are so euphoric and enthusiastic about it. I'll talk about what makes it hard. And then I'll tell you why genius plus clarity doesn't give us safety like they're supposed to. Perhaps they will with a few additional changes, but maybe CBDC is more efficient if that's what we want to only do. Okay, so that's the order of the talk. So the pro case, we've talked about it 24/7, faster, cheaper, safer store versus local, especially in emerging market contexts. One thing which has not been mentioned is if we believe on the crypto on-chain, lots of transactions are going to happen in the future, this could be a settlement asset. So that's all been sort of discussed. And a bunch of things that have been put in these acts, of course, as we know with all the rules, come from lobbies. Bank lobbies have shaped a lot of financial regulation in the past. Now there is crypto lobby as well. So when there are gaps in this, it's not because people aren't smart, it's because lobbyists are acting. So something that we should sort of keep at the back of our mind when I'll talk about a bunch of stuff. So forward looking, why do we sort of want to do this? Well, we want to stay ahead and think about smart contracts, so that we can have programmable commerce in the future. We want to get private competition going so that rates can be passed to the consumers without bank lobbies blocking it and so on. And we want to develop an innovation critical mass in the US. So all of that sounds great. Just so that you all know, like Darrell said, these things have been around, the stable coins, right? The circle and the tether thing. What's the size? 200 billion-ish. Projected to be that. And why is it not bigger than that? Well, because there are problems. And we'll talk about what those problems are. Now, just to also give you some sense, there are three types of stable coins that people talk about. One is backed by safe assets. One is backed by crypto itself. And one is backed by code, algorithmic stable coins. So well, you laugh, but these things are real. Okay. So we'll talk a little bit about it. So let's step back and try to link it a little bit to the economics that Michael talked about and Darrell also a little bit. Essentially, what we are doing here is creating a narrow bank. So we are basically giving up on maturity transformation. And we are going to create a narrow bank back in the day by thinking about also some kind of centralized supervision regulation, because these things, for them to function, require resolution, require audit, liquidity. We will see what I mean by that. And the historical debate always has been stability versus foregone bank credit creation. I know John Cochrane will have an issue with this. This is a particular type of bank credit creation, which is about maturity transformation. But that's the debate. This is going to be a similar debate, but it's going to be, because it's tech, it's on a code. So we will talk a little bit about that. There is a side discussion here about what happens if all of this becomes narrow and deposits, where do they go and so on, which kind of Michael alluded to. I'll come back to it later on why this is not such a big deal, but people talk about it because bank lobby sort of gets worked up about it. So let me give you some terminology on plumbing and why doing this is hard and where that comes from. So this is the same picture. So someone comes in, puts in US dollars, it goes to an issuer through the bank. So you need the banking system right now. And that person then puts it in reserves, issues some coins or tokens on a wallet, and then you can use that on the block. Why am I sort of putting it here? Because the terminology is going to be important. So this is on-chain. This is what's going to happen in the crypto world. And this is all off-chain. Okay, something to keep in mind. And both are important. So that's why I said I don't like plumbing, but it's important. So what must be true to maintain and think about stability? One is you need to have these reserves, whatever they are. They're amazing reserves, T-bills, cash, whatever have you. So you will need to have some audit off-chain, which is where the reserves are. You also need to think about on-chain. Why? Because you need to have coordination across different chains, different platforms, and so on. And there has to be things like if there is fraud and all kinds of weird stuff happening, someone has got to figure that out. We also need to talk about anti-risk taking supervision. I won't do that right now because Michael sort of talked a little bit about it. But just as a point to think about, when we talk about banks and hedge funds, we always talk about them doing risk taking to reach for the yield. There is no reason why this is any different. Okay, so there will be a reach for yield here as well. Who's going to look at that? That's supposedly state or federal regulators, and that has its own political economy that we can talk about separately. I won't talk about it right now, but it is an issue. If bad stuff happens, you need then some orderly resolution. The structure has to be bankruptcy remote. You need to have some redemption rules on T+0, T+1, and so on. There needs to be potentially a liquidity backstop in the middle. There needs to be interoperability across chains, across platforms, because there might be haircuts. The coins might not trade at the same price. So how do you redeem all that? What this is getting at, hopefully you all understand, is some kind of centralization if you really want to do all that, which, by the way, cuts across the whole notion that started all this, which is the whole notion was we are going to have a decentralized architecture, which is going to generate trust, which is going to replace the centralized architecture. So it's kind of a conundrum here. So let's talk a little bit about how good are we on all of these things, just in the context of stablecoins and Genius Act and Clarity Act. So here is what Circle stablecoin holds. So they hold treasuries, they have reverse repos, and a bunch of other stuff which looks like is cash and so on. How do I know this? Well, because Circle said so. Chain only shows you tokens, and attester only sees reserves off-chain. Okay, so that's important. And if that's the case, you got to rely on some accounting firm, some accounting rules. And attestation, first of all, is not high frequency. Some is weekly, some is monthly, either is monthly. That's not the same as full audit. And developing trust on this, as you know, is hard and can evaporate very quickly. So who monitors this? If we are going to rely on people, there are going to be problems. Okay, and we have seen this. Suddenly, when reserves disappear or someone is going to be audited months away and so on, or the auditors are cheating, they're all the common problems. They are not gone in this world. So we can talk about smart contracts and everything will magically work, but this problem has to be dealt with in some way, shape, or form, and maybe we will. But right now, it's unclear how. The other issue, this was off-chain, is on-chain, and that gets to the issue of there are bad actors, you got to freeze them, you got to do something. It's not free. When we talk about it's fast, efficient, these sound very buzzwordy and sound amazing, but blockchain is not free. To verify and validate, you need some resources. It's called gas, okay? So when you will need to tease out these people, you need more and more gas. That gas is not free. It's got to be charged to someone. Where is that fee going to come from? From somewhere. So where is that going to be coming and how is it going to happen? We don't know. The other thing is that you have many chains, many platforms, and if there's no uniformity of rules and policies, you can hop to other tokens all the time, okay? So that, again, is something that you got to figure out if you're going to develop a trust framework which applies all over. So transparency doesn't self-enforce. You need eyes, rules, and budget. And if you think this is just a figment of imagination, no, it happens all the time. There's a beautiful paper by John Griffin and his co-authors where they have done this tracking across chains. And what they find is when you're kicked off of one chain, let's say the Circle, the dotted vertical line here is when you're kicked off of Circle's stablecoin because you did some fraud. What do? You immediately hop onto another one, which is where you're going. This is called DAI. By the way, DAI is exempt in Genius very conveniently because you can just hop on there. Why is it exempt? Because it's not backed by reserves or dollars, it's backed by crypto. So it's off, you can do that and escape and live there. Why are we talking about all of this? Because it's all about financial stability. Like Michael said, this is the old story. You have a shock, Something happens to the coins, the tokens value, it gets depegged. Once it gets depegged, everybody wants to sell. If everybody wants to sell, there is congestion in the network. That means the gas spikes. Once that happens, you have redemptions. Once you have redemptions, the same old story starts. You got to sell reserves. If you got to sell reserves, this is what people worry about, which Darrell was getting at, that the pipes need to be clean because there might be spillovers to the treasury rates themselves if this becomes very high scale. So is there anything different? Not really. It's just going to be faster with the code. Okay. It's happened. Small perturbation in Silicon Valley Bank, USDC sort of goes crazy. It calmed down, but may not happen all the time. How do I know it? It didn't happen with Terra and Luna. In Terra and Luna, there was actually a run. It happened very fast. Now people have looked at some data on this. There is a paper by Antoinette Shore and Igor Makarov where they look at what is happening. And what's happening is, because it's blockchain and everybody can see everybody, you run faster. Unlike when depositors needed to look at the lines and so on, there is a little bit of a difference here. So backstop and rules are centralized by design, which kind of cuts across this whole notion that safety is going to be decentralized. It's not that easy, okay? So if you are going to make it stable coins and they're all going to be interoperable, it's not that trivial. There is an issue about fragmentation and singleness, which Michael sort of got to, so I'm not going to talk too much about it, but the basic idea is if you're dollar, you have trust in dollar because you can take the dollar anywhere and it works. If now you have chains where dollar is trading at different prices, why? Because the gas and the redemptions are happening at different places. Are we happy with having dollar trade differently in different parts of the world because we like stable coins and technology? Maybe, maybe not. Okay, so to summarize, this entire thing that I talked about tells you that maybe centralization is the order of the beast here. What does it replace? We can have a conversation about it. I'm just putting this just for your convenience to see that people talk about money market funds getting displaced, cash, cross-border. The only thing I'll comment about is deposits. People talk about, hey, deposits, once they go away, bank funding costs go up, lending is going to collapse. Well, it's not obvious because banks will reprice, but the non-banks exist and the capital markets exist to do this. So this is not an issue really. Genius Act, we talked about Genius Act, but if you look at all the points that I talked about, on-chain, off-chain runs and fragmentation, it leaves gaps everywhere. Like I said before, it could be because lobbyists are pushing us in that direction, but they are left. We don't have on-chain, off-chain fragmentation and run things, which I just told you, if you really wanted to address that. And it therefore points to the direction of an efficient, public, core-oriented system, which is what Michael was getting at, which is a CBDC. But the Clarity Act has banned CBDC. They have banned us to even think about CBDC or even to think about something like this in the future for various reasons. Again, is it something that we should be banning or should we at least leave it on the table? One issue is, well, we can't have the government oversight on all the privacy that we all love. But right now we are giving that same privacy and data to companies basically. So let's be clear that nothing is free here. So my thesis, Genius plus Clarity Act right now with stablecoins does not imply safety. It could work, but they might not be the most efficient way if we fix all this. And maybe the answer is CBDC if this is the only thing we wanted to do. Thank you.
All right, thank you very much, Amit. All right, our final panelist is Andy Hall.
Great, thank you. Super excited to be here and perfect timing coming after Amit because I'm going to talk about some of the same things. Just for context for people, I'm faculty in the political economy group in the GSB. I'm not a finance expert by any means. What I work on is governance, and in particular governance of the online world. And so I'm going to be speaking from a slightly different perspective in that way. As part of that work, I'm an advisor at Meta and at A16Z Crypto, so you should be aware of those disclosures. Great, so I want to talk about the ideology and the origins of this whole thing, which is what Amit was getting at too, and it's kind of puzzling to see where we've gotten from where we started. So crypto was originally motivated, as Amit said, by this idea of quote unquote decentralization. And that word actually has many definitions. No one is clear on the definition, of course. But in the case of money, there was a pretty clear declaration of what it meant in the original Bitcoin white paper, which is fascinating to go back and reread now. Encourage you all to do it. The very first paragraph of the Bitcoin white paper is all about how we really need a digital money that's irreversible, that you can make irreversible payments with, because reversibility is what leads to all these costs and the need for oversight and fraud. We need a digital version of cash. That then was picked up by other people and turned into this idea of what they call in crypto censorship resistance. This idea that you could have this digital cash you can pay people with, and no one else can come in and mess with that transaction. You don't need any other authority who you trust to decide whether that payment is fair or correct or not. I'm going to come back to that at the end, because I think that turns out to be a really important issue that goes way beyond payments in the online world. And I just want to flag at the beginning, crypto, the technology of blockchain, gets conflated with payments, but there is in fact an enormous amount of work. If you go talk to computer scientists who work on blockchain, much of the work is not actually about payments. And the same idea of decentralization comes up for these other things, because the idea is this is a way to do distributed computing or to create networks in which there's no central authority. And that could be really, really important in the online world. I just want to, there's a great quote that I always use from a computer scientist, Tim Roughgarden. The idea of the blockchain beyond payments is a programmable computer that lives in the sky, that is not owned by anyone and that anyone can use. I want to come back to that at the end, because as we head into this world of AI and agentic payments, which Darrell asked me to talk about, these questions are going to come back of what does it mean if everything we do online is mediated by a central platform? If we think about social media, where I've done a lot of work, for example, that's obviously a concern to a lot of people. This ideological origin of crypto, I think, is underappreciated today. It's odd where stablecoins have gotten to, given this original ideology. So where did stablecoins emerge? The idea was Bitcoin was going to be this censorship-free digital cash that no one could mess with. And whether that's true or not is somewhat debatable. There are actually ways you could take over the Bitcoin network if you really, really wanted to. But like, I think we could posit that that's basically true. The problem for everyday users was that, of course, it's super, super volatile. And so it's actually not very useful to pay people in it, because its value is bouncing around so much. And so early on, this idea of stable coins was very, very explicitly, let's take what makes Bitcoin great to people who care a lot about decentralization, and let's add stability on top of it. So this picture here is a very famous crypto founder, Rune, who founded something called MakerDAO, which at one point had $40 billion under its control, less now. And they created this thing called DAI that Amit talked about. And in the DAI white paper, it explicitly says the primary feature of a decentralized cryptocurrency is censorship resistance. And so the idea was, here's a way to make payments over the internet where the other person can trust that you're getting what I say you're getting, and no one can come in and interfere with the transaction. Since that time, that idea has become incredibly salient and important to people who care about crypto. This hasn't really come up in this panel yet, which again is like sort of odd how we've gotten to where we are with stablecoins. That idea is everything, right? And people who care about this will point to a bunch of episodes in America and elsewhere where they feel like the government has done a terrible job of overseeing these things. You can pick your favorite example. There was Choke Point 1.0, Choke Point 2.0, the Canadian truckers. We have Canadians on. They have a bunch of their favorite stories about this. And so that was the idea of DAI. Now, the problem with DAI, it turned out, and Amit was sort of alluding to this too, is it actually turns out it's super hard to make a decentralized stable coin for at least two reasons. One, which is the focus more of my work, again, not so much about payments, but just generally about governing online platforms, is what does it mean to have a decentralized stablecoin? Well, you're going to have to get a group of people together online where no one is in charge, no one has all the power, and have them make a bunch of decisions about how this coin works and write the code that underlies it and so forth. And MakerDAO, which produced DAI, constructed an unbelievably interesting governance structure that involves weekly votes, and the votes are self-executing on the blockchain. They developed a system of representative democracy. It's quite professionalized. The delegates, these representatives, are paid hundreds of thousands of dollars a year. It's fascinating, but it's also super difficult. There's all the standard agency problems we see in democratic systems playing out in this online platform that's trying to make decisions about how their stablecoin operates. More practically speaking, it's also really, really hard to keep the peg. And so this is a picture that kind of, it's a nice pair to Amit's. This is DAI's peg over time. It's a little hard to see the y-axis there, but the two things I want to highlight, there's of course this very salient complete loss of the peg, and that is the Silicon Valley bank disaster. But even prior to that, even under normal operation, you see it wiggling around way more than someone would normally deal with. And that's because of the extremely complicated mechanism DAI uses. DAI doesn't want to be backed by the kind of treasury assets we were talking about before, because their whole idea, again, is censorship resistance. And if the idea is you're backed by this thing that the government can do stuff to you with, that's not what you want. It turns out it was impossible to keep DAI stable without that. And without getting too much into the weeds, maybe in the Q&A, if people are interested in this, they ended up holding a ton of USDC in order to keep DAI stable. And then some of the people involved were very upset about that. And that became a fascinating debate. With that background on the history of stablecoins, it's then very notable to see where we've ended up today. So this is from the White House explainer on the Genius Act. You can see that it's required, if you fall under the terms of the Genius Act, your stablecoin issuers must possess the technical capability to seize, freeze, or burn. Here I'm showing you the actual smart contract code from Tether. This is prior to Genius. This has nothing to do with Genius. It was already the case. Tether can come in and blacklist any address that they want. That's true of USDC as well. So it doesn't seem like stablecoins as designed here are achieving the original ideological goals of stablecoins. And so then that's a puzzle. And it raises, I think, some profound questions about where we're heading and what the purpose is. And so we saw, I think, in Darrell's talk, some very interesting projections of places where this could be useful. And I think the key question for every element of where this could be useful is this a case where the decentralization of the stablecoin is actually important or not? And it might be in that smart contract case you gave, maybe there is no trusted third party you're willing to have oversee that swap, and then you really do want Ethereum or something to be the provider, but maybe in lots of other cases a permissioned network would be okay. And so that, I think, is the fork in the road where people haven't always been clear on where is blockchain uniquely valuable. Having the decentralization of Ethereum or Bitcoin or other blockchain comes with a lot of costs. It's very unwieldy to maintain the decentralized nature of the blockchain. For certain uses, it could be very, very valuable, but there may be lots of others where it's not. So I think when I look into the future, again, from a governance perspective as a non-payments expert, you can see arguments both ways. I think the bear case for this idea is that you're going to end up with these super centralized stable coins like we're seeing right now. They're going to end up looking just like the thing they were trying to avoid being, like a CBDC or something like that. And there might not be anything else about blockchain that's giving you value. So if it's just about programmability and things like that, you can get those without blockchain. On the other hand, it might turn out that there still is value to this approach. It could be that there's something about having the fact that these stablecoins are at arm's length from the government might provide some kind of meaningful insulation that people who care about that censorship issue might value. There is also, and this came up in Amit's talk a little bit, currently in the policy, there is still this path to decentralized stablecoins who are actually not subject to the Genius Act. And so there's some question of, will people actually end up wanting to use those instead? So again, we know there's a lot of practical issues with them. I just want to step back, again, where I come from is really much more about the power of online platforms more generally, and payments are one interesting feature of that. What I have here is a screenshot of a truly great commercial. You all should check it out if you haven't seen it. This was a commercial that Epic Games, the maker of Fortnite, released when they sued Apple over the rules of how Apple oversees payments in the App Store. So without getting too much in the weeds in my last 30 seconds, I do think this is really important for understanding the coming battle over agentic payments and AI agents. The issue was Apple took the position, you have all these kids playing Fortnite on their iPhones. They all want to, the way Fortnite makes money is in-app purchases. Apple's position was, you install that through our app store, we get 30% of every transaction your kid makes in Fortnite. Epic Games didn't like that. They said you should be able to go outside the app store, use Safari on your iPhone to transact without that cost. Apple kicked them off the app store, and that led to this huge litigation. Epic Games kind of won the litigation. As usual with the Supreme Court, is super complicated. But we're going to see that battle come up again with agentic payments. People are saying stable coins are going to be this key. This didn't come up in any of the talks, but in tech, people are saying stable coins and AI agents are a perfect pair. This will be this way that your autonomous agent can make payments on your behalf. I think coming back to this governance question, it's all going to come down to who is going to sit on top of all of those transactions that the agents are making. Google released a proposal for a protocol. Ultimately, the question is going to be, is OpenAI getting to mediate all of the transactions that these AI agents do? If so, they're going to be able to impose their own rules, just like Apple did in the App Store. I don't see why stablecoins as they're built right now are going to solve that problem. If you had a world of completely open AI agents and censorship-resistant stablecoins, then you could imagine a super weird world in which AI agents are freely transacting for good and probably for ill as well. So I'll leave it there. Thank you.
Thank you very much, Andy. Okay, so I want to initially just go to the panel. If you want to agree, disagree with what each other said for a little bit, and then we'll open up questions for the audience. So I will let you do it. I mean, one thing that occurs to me is that that big computer in the sky just doesn't work as well for money as the invisible hand does for the exchange of goods and services.
I just want to amplify some of the history stories that I told and try to relate it today. So, and Darrell raised this, what are the incentives to become a stablecoin issuer, right? If it doesn't pay interest. So like with the national banking system, the way it worked is you had these bonds. Okay, the value of the bonds was less than you could issue. I mean, it was more than you can issue, but you could, based on those bonds, you could then issue these notes and lend them. Okay, and so you get interest on the loan. Okay, another way of looking at it is that the private sector shared in the seigniorage. That's the incentive. Okay, so let's think about today. I have three examples. JP Morgan, Circle, or one of these companies, and say the Trump family. Okay, something like that. Okay, so JP Morgan, you know, they actually could benefit. They set up a narrow bank. It's 100% back. It can be backed by cash, by reserves. So why are they going to do this? Well, because it's a tie-in sale. People know it's really going to be safe, and they can offer all kinds of other services. So I think JP Morgan stablecoins could probably solve all these problems. The crypto companies, I'm not so sure. I don't think they don't have the history, they don't have the credibility. Okay, there are all these issues could come up. And then the third one, so I made this distinction between large stable coins and small ones. Small ones are regulated by the states. Okay, now it says in there that the states are going to be overseen by OCC and all that. So my history tells me about the free banking era. Some states actually did a good job, like some of the East Coast states. The Midwest states did not. Okay, and also I could see a situation where you could have like almost corruption going from the state, from the state regulated stablecoin issuer to the examiners. I mean, so that there really are some serious problems other than just the problems I've talked about. Okay, so all this has to get worked out. The second point I wanted to make is systemic risk. Okay, and I see, we've been talking, I see that the systemic risk, and if I were a regulator, And I've been talking to some friends in the Fed. So what are they worried? They're worried about where the bodies, where is it gonna hit us? Okay, it could come in through the backing. So even if you have US Treasuries, right, if something goes wrong, like now, okay, let's say there's a bad ending to what's going on at the Fed, okay, and there's a run on the dollar and there's a crash in US T-bill market, that affects the backing. Okay, shocks of all kinds could affect the backing. And then you've got, shocks coming from everywhere. And so there could be a feedback between the shocks to the stablecoin issuers, problems with stablecoins feeding into the rest of the economy. So that's the nightmare scenario that people at the board are thinking about right now. And they need to be worked out.
So I'm going to go first to Don Wilson, who's the founder of Canton.
Okay. Yeah, so this was a great discussion. I really enjoyed it. Just so everybody has a sense of who I am, I'm the founder and CEO of DRW, which is a proprietary trading and markets innovation firm. We founded Cumberland in 2014, which is one of the largest cryptocurrency liquidity providers in the world. I'm pretty sure we have redeemed and minted more Tether than anybody else in the world. So, when you show the disparities in DAI, we're, very familiar with those. Although I would argue that those are, it's a far less than a credit card charges in fees. So, pretty good. One point I want to make is that this idea of censorship-resistant money is it's a great idea, but it's practically impossible as soon as you have something that is tied to the real world. The unfortunate acronym that the crypto community has adopted of RWAs, which I always knew as risk-weighted assets,
yeah. Real world.
but I guess now means real-world assets. As soon as you talk about on-chain RWAs, they're not censorship resistant. It does not matter what you do. There has to be a trusted issuer in the chain. And so it's just a question of what the least bad solution is that enables us to benefit from the ability to all the things that blockchains provide, and while mitigating the risks. So of course, if you had a CDBC, that would be a much less risky form of digital money than a stablecoin, and but there was strong backlash because of all the things that the government did to punish people who didn't spend money in the way that they wanted. And I think that that's a legitimate concern. So creating this barrier where a private issuer is one step removed from the government. Of course, if the government gets a subpoena, they can go to Circle and ask them to shut down somebody's money or give them a history of all the movements for some particular wallet. But that does create a nice buffer that I think improves the things. Now, I think that for wholesale payments, especially, for instance, repo settlements, this idea that we're going to accept this incremental risk in the system may be untenable. So another solution that could solve both problems, it would be if the Treasury started issuing a new form of security that pays interest maybe at below the target rates. So this would be beneficial to the U.S. taxpayer. Maybe it's 50 basis points below the risk-free rate. And an entity like the DTCC could then tokenize those securities on a blockchain.
Yeah.
Similar to what DTCC did with treasuries in the example that Darrell showed with the on top of the Canton chain. And those securities would then be clearly one-to-one, at any point redeemable for dollars, and would even bear some interest, but would still be one step removed from the government's ability to constrain things. So I think that something like that could be an interesting solution that gets us most of the way there, that solves both of these problems.
Thank you very much. All right, Mike Boskin.
Yeah, thanks for everybody. It's terrific. Exceeded my expectations, however rational they were. Three real quick comments and a question for all of you. The first is, Andy, if you think the governance problems can be solved by the owners, look at the history of the mutual form of organization. Didn't work out very well. Credit unions haven't exactly replaced banks. Mutual insurance companies, even with big tax advantages, didn't replace stock insurance companies, et cetera. So just FYI, it may illuminate some problems. Okay. The second point is that some of the rest of the world has started moving in various ways. You didn't talk much about that. I know, at the risk of Darrell knowing 100 times more than I do about that, probably admit to, just FYI, the Chinese have the ECNY. They're very, very, maybe because of their system, they want to control their power, et cetera, the party. They're very much against decentralized stuff. So they have a centralized system plus fintech, right, with ECNY, which, as I understand, they're using in Belt and Road and Silk Road payment systems and transactions. The UAE, Europe also seems to be somewhat resistant, and for know your customer and risk reasons and stuff like that. And they're also desperately trying to get a euro digital currency. The UAE has had an interesting evolution. Now they're tiny, but they seem to be moving towards something that seems to make more sense to me, which is sometimes it's called a pyramid of these things, where you have a central bank digital currency that is the public safe asset in people's digital wallets, that it generates the foundation of trust. Then you have stable coins for peer-to-peer and international transactions. You have tokenized deposits for interbank transactions. Now, with the risk of that creating its own risk and opportunities for people to find flaws in it and exploit it, et cetera, what do each of you or any of you think about that as something that might work?
Well, I'll take a quick shot at it. I mean, the idea that central bank money is the medium of exchange among banks is what we have today. We have a digital central bank currency. It's just not on a blockchain. And putting it also on a blockchain, in addition to the way that it's recorded today, would facilitate programmable payments. And then people could build stable coins on that, backed by those, or by the coins that Don just described, issued by the Treasury. And that would be fantastic. I think the system would run better. Now, it's a market decision once the government issues these things, whether they're going to adopt it or not. There's a lot of vested interests. So whether, the market would go for that, remains to be seen. But having that utility underlying the banking system would be nice.
But I think I completely agree. If you also look at the Brazilian and the Indian system, where they have a public infrastructure, but there is a separation, like what you were saying, where private entities can then build and offer products. That seemed like a much better way of doing this, because essentially what we are arguing is that this whole trust technology, the most efficient way of providing it, we have a good sense. So we don't need to rediscover it and have competition, and where there's going to be no credibility building it. But once you have that, then you can do all the innovation and other things that we want in the system, which, for various reasons we have not seen in the payment sector.
I really appreciated your emphasis on safety. When I was in the government, I had to deal with, getting back to the plumbing analogy, with poor monitoring of the plumbing when we had to clean up the S&Ls and third world out of the money center banks.
I
was
didn't
not a
want
lot
to
of
go,
fun.
I didn't want to give more analogies, but yeah, I figured that everybody got what I was saying.
But I mean, I always liked the public-private partnership approach that the Bank of England was pushing up until recently. And that was what Andy Levin and I were talking about 5 years ago. But you got the CBDC at the bottom, and then you have banks, their partnership, and people can bank accounts that are 100% backed by CBDC, and they could pay the interest that's paid on reserves. And I thought that would be a great way to go. But of course, what happened was the banks immediately said, wait, we're going to get disintermediated. We can't do this. And they shut it down. But I'm still not clear that there's any, that would really have happened.
Okay, so I have 4 names of people who want, or not names, but 4 people. So I'll go to the 2 of you, and then Jennifer Burns, and then John Cochrane. And I apologize, I don't know your name. So if you could state it to start with.
So my name is Don. I am involved in uphold and figure and issue tokenized real world assets. Although I'm a quant, so I agree with you. The original acronym was better. And I thought I'd throw some critical facts into the debate here because some things have been said and some questions have been asked that indicate that there might be a few facts missing from the analysis here. First of all, the relationship between the US government's balances of 35 trillion is to the amount of transaction activity that goes on with the US dollar is 100 to 1, 3.5 quadrillion a year versus 35 trillion. Interestingly enough, that is the same ratio that applies to stablecoins. Stablecoins at the end of the year last year were 26 trillion versus 250 billion of balances. So this notion that transaction activity is irretrievably connected to backing is simply either fanciful or irrelevant or not related to what's going on at the moment. Second thing I would say is that right at the moment, we have a lot of tokenized assets. We don't tend to call them that. Let's talk about ETFs, which being ancient, I was part of the development of. They today, mutual ETFs represent $25 trillion of America's $55 trillion of wealth. Of that, 7.5 trillion is money funds, backed by the very same assets we've been discussing. The revenue on those ETFs, those money funds, to the institutions that offer them, is approximately 10 to 15 basis points. The revenue from stablecoins is the yield on those underlying assets. We'll just call it 550 basis points. So if you ask why does anyone boot up a stablecoin, you just need to look at the revenues. Now, I'm not making a case for Circle's arithmetic. There's a lot to know, which I suspect we know, about how Circle and Tether spend that money, including by buying European soccer teams and turning around and paying other members of the community outrageous hostage money for the right to be part of the ecosystem. But just to do the math for you, the total revenues of that $250 billion of stablecoins is equal to the total revenue of the $7.5 trillion of mutual fund money management fund, money funds in various forms. Second thing I would say is, and then I want to ask a broad overall question, which will have no rational answer, but I'll throw it out there for the hell of it. The second thing I would point out is that we haven't given enough credit to the arbitrage function that exists within these redeemable instruments. At the end of the day, the price of stablecoins, dollar-backed stablecoin, backing stablecoins, and of real-world assets, arguably, lies in the interaction of the mint and burn structure, which periodically, either continuously on chain in the case of a money fund or a stablecoin, or periodically in the case of real-world assets. And by the way, the linkage to the TradFi world of real-world assets is inextricable. So I agree with that observation too. But because of the ability to redeem at any time in the face value, the stabilization of the price of the currency takes place not in a committee room somewhere in the Fed, not in the underlying regulatory architecture, which moves at the, well, let's just say not at the speed of light. It takes place in terms of real arbitrage which is I think a stabilizing factor that is, well, it's recognized by those of us in the industry, but I think it's under-recognized by groups like this as an alternative to deliberative activities. So I guess my final question ties into that. You all seem to have a lot of confidence in a process which has failed us collectively since it was invented, called the committee. Whether that committee has power or not.
You know, you're speaking to faculty members who couldn't agree with you more.
Well, I have little experience inside that process, but I've watched the bloodshed. So, and yet everything we talk about when we talk about government action, and I would argue even in governance, is committee-based. And we have this faith that whether it's regulating AI or regulating the blockchain or regulating human behavior or regulating your pronouns, no matter what we talk about, we are always willing somehow to trust a committee rather than some sort of equilibrium-based system, because we all know the failures of an equilibrium-based system because they're so dramatic. But the failures of committees are endemic, persistent, and inescapable. So how do you think about the faith you seem to have in some sort of committee?
I can answer that very quickly. I'm very religious.
We only have a
Hold on.
we only have a little bit of time, so I was going to get comments from the three last ones, and then you guys can. So go ahead and get. I don't know your name, so please state.
Jared, I'm a research fellow at Hoover,
Okay.
and I'm just going this very quick. So I think my question has been asked, like sort of like, what could the pros and cons inform America's adversaries or competitors in terms of the US dollar, like China?
Jennifer?
I have a similar, perhaps, question. I'm curious, just for the panel, to kind of walk me through how you're thinking. I see the case for CBDC as you outlined it domestically because of the problems it would solve. But to the extent that the US not going that route inhibits the broader system, other nations from not going that route, is that potentially a positive in terms of dollar dominance? I'm thinking of your chart, Darrell, and you show the stablecoin disintermediating and just allowing direct transfer. If we blow that up to the macro scale, doesn't that perhaps imply central bank to central bank with no US dollar intermediation? And given the adversarial shifts in the world, isn't that something we should have our eye on? Or am I just thinking, am I off base in thinking about that?
I have a short question for you, Andy. I'm amazed to learn that stablecoins, government can push one button and seize and freeze you out like the no-fly list without a subpoena, without a judgment, without recourse or whatever. We have to balance somehow anonymity versus collecting taxes one of these days, but I like Don's structure. It's a private thing, you need a subpoena. Amit, it seems to me the answers to all your worries are CBDC reserves, or my favorite also, fixed value floating rate overnight treasury debt, BACs, stable coins, segregated accounts, money market funds that are allowed payment services, and we have reinvented the narrow bank, which is the thing. Or you have risky assets plus an equity buffer and some regulation, and we've tokenized the actual bank. That seems like the answer. Darrell, the message I'm getting from you is that exchanges, margins, collateral, escrow, it's all out the window. We're going to tokenize this whole operation. I think we just get to cheer. And last for Michael, there's a big difference between 19th century and now. We have instant communication. So if I walk into a store, I know what the value of a Minnesota thing is. In fact, I could even know what the mark-to-market value of their assets are, which would seem to help a lot, which raises the question, why do we need run-prone demand on demand in order to have liquidity transactions? Okay, Bitcoin's a little bit too much, but if these were very clear assets, ETF, trading in a small band, that would seem in today's technology to provide all the liquidity you need without the run-prone nature and without the dangers that you had historically.
Okay, Krista.
Can I go, because I have a very short yes, yes to Jennifer, and yes to yours too. So, and now I see the flow.
Questions?
But others can now. I give you the time.
No, I,
because
I agree with Jennifer. I think that's going to create a problem. If the other countries all go CBDC and the US doesn't, that will be an issue in the future. And John, yeah, I mean, sure, that was an information problem and this would get around the information problem, but there were still other problems too that this wouldn't get around. Okay, but that, yes, that I agree.
I want to talk about this issue of dollar dominance that both Renjin and Jennifer asked about. I think it's a terrific question. So there's a distinction in my answer between smaller countries that don't have really strong payment systems and banking systems on the one hand versus countries that are developed and probably not susceptible to this kind of dominance. So those smaller countries are in play right now. Like yesterday, it was announced that China would give up $215 million of value on a loan to Kenya if they redenominated it in renminbi. And they are trying to get more and more smaller countries that are kind of on the boundary between which geopolitical faction that they're in to go to renminbi. Now they're going to have a hard time because the dollar is just so hegemonic globally. But at the margin, it's an enterprise for the Chinese government. The U.S. government is kind of less organized and just saying we have dollar stablecoins. We're not going to do a CBDC, which is harder to manage. But you know, a free market, go ahead, invade the world with dollar stablecoins, and that may be quite a successful strategy as well.
Darrell, I just came back from Europe and I can report Europe is going to shoot themselves in the foot and make sure to regulate this thing out of existence before it starts.
Yeah.
And Switzerland, where I also was, the last thing they want is a stable coin because then they would have to issue more Swiss francs to back the stable coin, and they don't want to do that either. So our major competition is
I think you two raised both a fantastic question.
No, I just say, I think the questions to me raised this, I mean, I think the censorship resistant thing is underrated, certainly from the politics of this. I can't imagine a CBDC in the US anytime soon.
Can I ask you just to clarify? So is it true in the current legislation that with no legal procedure, somebody in the White House can say, Andy Hall, boom, it's all gone?
I'm not,
No.
The last thing I want to do is.
not that draconian.
Oh, absolutely
No.
not.
The requirement
You have to
is
get a
that this.
KYC
You need a
AML
subpoena.
problem.
Yeah.
Yeah.
KYC AML issue was not imposed within the network. It was imposed on the network because the original transfer activity was largely like $100 bills.
The
right? How
special
many of them are in
report
our
has to be
pockets?
filed.
Yeah.
There's a process. It's not
Okay,
that.
thank you.
Yeah.
The blacklist. The
The
blacklist
issue
and
is
the
just
whitelist.
the issue is just you can hop around. That's a separate matter though.
All right.
Any of the stablecoin issuers can freeze a wallet.
That's true.
Yes.
And the government can, if they have a subpoena, go and ask them to do that.
Correct.
But they have to, you know, I mean, obviously, just
Just like a
like
bank
some of the,
account.
yes, just like a bank account. Of course, you know, a stablecoin issuer could behave like some of the social media companies did
Yes.
under previous
That's, I think, what you were
administrations,
getting at.
and that's a concern, but they don't have to.
Well, I want to thank the panel and all of the participants for a fantastic